So we're going to open up the risk management toolbox. We're going to talk about these two concepts first. And again, these are very short, very easy. And the frustration of it is we'll do fundamental analysis forever trying to find a stock. And we'll do technical analysis on it for every indicator forever. And then we'll decide, gee, do I want to buy the stock, sell a put to acquire the stock, sell a call to get short, or, we'll go through all the three pillars that are huge. And I guess by the time we get to risk management, we're out of gas. And we don't do that type of stuff. So I'm going to be very forceful, on our coaches to stress risk management. We get so excited about driving the car and where we're going and the gas mileage. It's a seatbelt. Put it on. I had one save my life. The person in the other car did not survive. I survived for one reason: little strap around me. Tragic stuff. Wear your seatbelt. Do this. So we have this earlier in, I believe, the cash flow section. We probably talked about a little bit in technical analysis. We do it in the beginning investor boot camp, and we're going to do it right here. So very short. We're just going to pull these two out of the toolbox here. And the first thing we're going to talk about is risk to reward ratios, or reward risk ratios. Now, this is a basic concept, and I'm going to jump all over everyone to say, look, this isn't exactly how it works. We're using a metaphor to get a basic idea here. So the idea is this. Let's say the stock right here is at $100. Okay, it's at $100 where we enter. The chances of that stock going up are 50%, and the chance of it going down are 50-50. It's 50%. And we're going to see that in some of the probability software that we look at. So even though we're in an uptrend, it's still, this probability is 50-50. That's why we do technicals, to hopefully we have some insight that the computer are just 50-50. We do some fundamentals where we hope it's going up. But the reality of it is, after everything is said and done, it's either going to go up or down. So if we have a chart that we say, look, it makes sense that it could get to 120, right? It makes sense that it could get to 120. Let's see if I can get my thing to work. Well, now I have $20 of upside, and I have to feel like it can get there. I say, but if it heads down, I'm going to cut it off at 90. Maybe it even can get to 80, but I'm going to cut off at 90. That means if I'm right and it goes all the way, I can get 20. If I'm wrong and it goes down to here, I lose 10. Now, this isn't a reality in that it could go here and stop and turn, and all kinds of stuff can go on. But the basic premise of this is have a larger upside than a downside. That's it. Have a larger upside. So if it's 50-50 and half of them hit this and half of them hit this, which won't happen because some will go sideways. But if it's 50-50, you have more chance to win than lose if you were a 50% trader. In other words, if you're right half the time and wrong half the time, that's where it would be. Again, please just understand the basic concept is really not about this so much as, look, just leave more room here than you left here. Just leave a lot of room here and less room here, and that's it. Why actively manage this? Why mess with this stuff? Why do the exit? Why not just buy and hold until you die and diversify? Well, here's why. Lehman Brothers is a good reason. WorldCom is a good reason. More recently, Delta United Airlines, not too long ago, where, they revamped. You could have got airlines for $5, But if you hold these while they go bankrupt, you have to start over. You lose all your money. You don't get to, reinvest all those profits at the new low one. And it's just tough. Now, we've had examples like this, and in order to exit, it's very simple. We put in how much we'd like to sell, the symbol. We use a stop market order. It's going to be a sell. And we put in a price where we say, hey, get out of this thing at 37, right? If it hits 37, get out and get a nice risk-reward ratio. Well, I'm going to actually spend most of my time not in the slides here. And we've done this a couple times, but we've done this in the boot camp as well. But let's say I bring up Target, and we'll do a couple things here on Target. So we and I just pulled this up randomly. It could be anything. So here we have a nice gap up, And I'm just going to identify these points as lower lows. And I'm going to identify these points as higher highs. And so it looks like we're in an uptrend. And maybe we can get to 120 right there. And maybe we're going to buy it on a pullback down here at, we don't want to pay any more than maybe 107 for it. So we say, look, if this thing comes down, sits here, starts to bounce up, maybe we buy it. And yet if it goes further, we want out. Now look at this. I'm going to take this low at 105. So if we buy it, let's say at 107, this low at 105, that'd be $2 a room that we're willing to lose. So maybe we do 100 shares and we say we're willing to lose a couple $100. Or maybe we do 10 shares and we're willing to lose $20, whatever the math is. So now we have an up possibility and we have a down possibility. And I'm doing this based on some support, saying, hey, if it falls below support. Well, another way we could do this is with the ATR. And, this one will make me actually kind of lucky that this might feel pretty good is, we said we're going to give it $2 based on the support. Well, here it says its average true range right now is about $1.67. So it's normal for this to move and wiggle $1.67 up or $1.67 down. Now, if it were to wiggle more than that, well, that's not average. Something out of the ordinary is happening. I might not want to be in this thing. So I don't want to get whipsawed. I don't want to be too tight. So I might say, look, let's just take $1.67 and maybe I times it by 1.5 and give me a little more room. And look at that. We get $2.50. So I say, you know what? That's pretty cool. I've got support here at 2. 250 would be a little bit more than an ATR. I like that idea. So if I'm right, I got a lot of room to grow. If I'm wrong, I'm cutting it off quick. And it's that freaking simple. Now, why don't people do it? Well, I'll tell you why. Because it means you're going to get exited a lot. It means that there's going to be a lot of trades where it goes down and stops you out. And how does that feel emotionally when you get stopped out? Well, for new guys, it feels terrible. I lost. I was wrong. Look, it's not about being right and wrong. It's about being smart and dumb. You did your fundamental analysis, and it was good. You did your technical analysis. It was headed the right way. Hey, it changed. Okay, it changed. But we don't want to ride it all the way down. There's enough that'll work out for us that we can cut these losers. If this is not a gambling thing, but there's times to fold them, man. It's time to pack it up. And that's a win sometimes if you only lose. Because if it fills this gap, if it falls apart and, you got earnings coming up, if it falls to here, you'll wish you had that $2. You'll wish. So that's important stuff. So how do you do that? Well, there's a lot of different ways in software. Right here, we're gonna buy custom with a stop limit, okay, or with a stop. And I'm going to explain the difference between a limit order and a stop order. This is also in the boot camp. And so let's say that we will not pay any more. We want this to drop down, we decided a little bit before, see if it drops down on that trend line. We say, you know what? We're not going to do this for more than maybe $1 or $107. So in the price, we say we're not going to pay more than, just an example, $107. Done. Now this limit means that we wouldn't buy it. We have a limit on what we're willing to spend. We're going to buy 100 shares, and there's a limit on what we're going to spend. We're not going to spend more than $107. Then we take it down our ATR, $2.50. That's going to be 107 minus 250, right? So 107 minus $2.50 is going to be 104.50. So down here, we're going to say 104.50, and we're out. Now, this is important, okay? We like limit orders to get in, and we like market orders to get out. Let me say that again. Limit orders to get in and market orders to get out. We want to be able to control what our entry price is, and this allows us that control. That way we don't just say, hey, buy it at market, and it gaps up and we pay too much for it, and it's already, run on a bunch of the room. No, we want it to fall down, get in it a little bit, and at that point it's either going to go up or down. You could wait for it to fall down and do confirmation. That's fine. You could do that. But this is the key. If I do this, then I know that the most I'll lose in this trade is a couple bucks, $2.50. That I know. In this case, it'd be $250. If I'm not happy with that, I take my position size down, right? I take my position size down. So a stop order has a stop price. Now, this is called a stop market. And it means that if this travels downward the wrong way and it hits 104.50, it immediately sends in a sell order, and I'll get out at whatever market is. And this is a high liquid stock, so it'll probably be close to this. So I'm picky getting in, but I'm not picky getting out. This one right here is only good for the day, because if it doesn't do what I want to do that day, tomorrow's a new day. Again, I want as much control as I can. But if I do get in, immediately this stop will be there, and that's an important thing. I don't know, do we have any stops on some of these right here? We might. Okay, here's a stop and stop limits where we have orders. Let's get rid of this here on we'll look at Visa. So right here we have orders that take our profits if it goes up, and orders what? To get us out if it goes down. See that? Orders, and see that's a nice reward and very little risk. So that's it. I mean, it's not earth-shattering. It's not that difficult to do, to have that stuff. When you do this, you can do it with technical analysis, or you can do it with an ATR. If you want to be more conservative, tighten it up, but you're going to lose more often, but you'll lose less. If you want to widen it a little bit, I really like what we did there. So if I can find some level of support that I like, and then find an ATR that makes sense that's maybe a little lower than that. That way, if it breaks support, it's wiggling more than it should, I say, you know what, now I have reasons to get out instead of just hoping to get out. So definitely worth the time with whatever software you use to learn how to do a stop loss and a risk to reward ratio. To use and you can see how our technical analysis is important here, to understand support and resistance, to understand how to set a target, how to set exits. You check things out in Mentor Club, where we do this all the time and set stop orders. But a person should not trade if they don't know how to do order entry, and practice and practice and practice. And the best way to practice is in a simulated account. Let's go back to that target trade, just for fun, just using it. And let's go back to this idea of buying with a stop limit, to where here it says, okay, what am I going to do? I'm going to buy stock. I'm on the buy side. I'm buying 100 shares of Target. I'm buying stock, and I'm going to put my limit price down at 107. That is the most I'll pay for that stock. I don't want to stop limit. I want to stop market. Where'd that go? So we got to make sure we get the right one in here. So we just want a stop order. There we go. And we decided it was going to be 104.50. Fantastic. This is going to be good till canceled. This is good for just the day. If I don't like it, I don't want to be in it tomorrow. If I do, I can always redo it. Now, when I hit confirm and send, it has all this stuff in here, with all my, the both order descriptions. I'm going to buy 100 shares of Target at 107, no more than that. That's my limit to open the trade. And, I'm going to sell in that stock if it hits 104, and it's going to be triggered by number one. So if this one fills, then this one will be standing there ready. I'm going to buy 100 shares, so it's going to cost this. And then it gives me my buying power effect. Everything is there in what we want. And it's a simulation. It's not a real trade. So it's very, very important. With stop orders, no guarantee the execution price will be equal or near the execution price. So we want to have high liquid stocks. And we're going to show you, if that makes you nervous and you want more protection, well, then you can pay for it. And there's so much more to learn about this. But then I could send that order in if I wanted to do it. So that's a little bit on stop losses. That's one of the main risk management tools we have. Now, some people have what's called a mental stop loss, where they say, well, I'm not actually going to put this order in. I'll just kind of keep track of it. You can set alerts if you want to see what the market's doing and why things happen. But I will tell you, As a person, if you're just starting out, mental stops are for the mentally insane because you'll forget about them. One of the things that, a couple of my relatives that have tried to trade do is they don't put these on, and they don't put them good till canceled, and then they get busy and forget that they have stuff on in the stock market. They come back a week later, check on it, and they're down $9. So this stuff is putting on a seatbelt. You can feel the strenuousness in my voice. Use stops. Learn to use stops if you're going to trade actively. Learn to use them and protect yourself. So with that, those are two really cool parts of the risk ratio stop loss order. When we come back, we're going to look at protective options. Particularly, we're going to use the protective put. The protective call is just the opposite. The protective put. If you're short, you want the right to buy back. If you're long, you want the right to sell. It's that simple. So we'll do the protective put, and I think I'll even splice in some good mentor clubs. So if you're not in the mentor club, you can experience what it's like in there, how we do this stuff live. And if you are in the mentor club, and great job, you'll know that it's always worth listening to, right? So either way, you win. We'll be back. We'll do protected puts next.